I welcome you to this session. We'll be discussing the topic of how to finance an enterprise. The financing of an enterprise. The objectives of this unit is to understand the need and various forms of financing the business, appraising equity and debt financing options, to realize the challenges faced by the enterprise for financing at initial stage, and analyze the current scenario with respect to various sources of financing, the research that goes on, the current scenario with respect to various sources of financing. This is the structure for today's unit on financing an enterprise. We'll be looking into the various sources of finance, stages of business development and source of funding, bootstrapping techniques, angel investors, venture capital investors, term loan, debentures, etc. Our focus will be on to understand who are these angel investors and the venture capital investors, and the various bootstrapping techniques. This unit discusses the various sources of financing used by the entrepreneurs at different stages of venture development. There are many challenges that an entrepreneur has to face while starting the business. Arranging fund for the business is one of the critical stages. At the initial stage, while the entrepreneur is exploring something new, all the investors, many of them shy away from such projects, as the risk of losing money is very high at this stage. The traditional funding options are not suitable. Despite many challenges, there are enormous opportunities for entrepreneurs in India. To match the requirement of funding at this stage, the ecosystem of entrepreneurship provides the option of risk capital, which mainly includes angel investment and venture capital investment. So our focus of today's session will be on these two aspects, angel investment and venture capital investment. We'll try to understand both these two types of investment in detail. Both are in the form of equity investment, and these investors play an active role in the management of startups. As the risk is very high at this stage, these investors expect higher returns as well. Although angel investors are informal investors and do not invest in the venture just for the monetary gain. Once the venture reaches to a stage where no further hand-holding by the investors is required and there is no uncertainty about the cash flow, the entrepreneurs can explore the option of raising debt capital in the form of term loan from the banks or financial institutions, or through issue of debentures. So we'll also look into term loans and debentures. These debt funds help in expansion of existing line of business, diversifying to new businesses, or buyout of small companies. So let's begin understanding this unit of how an entrepreneur finances his new enterprise. So, having checked the feasibility of a business idea in yesterday's session, and having been ready for the project report or prepared the project report, it is the time for an entrepreneur to look for options for financing the project. So We will now take a look into the many challenges related to finance that the entrepreneur has to face at initial stage of business development. You will know that in the seed or startup stage, the entrepreneur may not have sufficient collateral to be offered to the bank for availing the traditional term financing. Moreover, in the initial stage, the funding requirement will be very small and the risk will be very high. So, investors may not be interested to invest their money. If the entrepreneur is starting something new for the first time, there will be no proven commercial success of his or her business idea. So it will be very difficult to attract external investment, and the internal funding may not be sufficient to execute the business idea. At the initial stage, the entrepreneur may not have the reputation or credibility in the market to attract the external investors, which can be a challenging task. So initial public offering is also not a viable option for raising the funds at this stage, as the new ventures may not be eligible for IPO as per Securities and Exchange Board of India guidelines. However, funding ecosystem for entrepreneurship has evolved over a period of time. Government of India has taken a number of initiatives to promote the startup culture in the country, which we have discussed in one of the earlier sessions. So by learning this unit, you will be able to understand various sources of finance and their applicability according to the stage of business development. This particular slide actually shows you the sources of finance. It can be of two types: internal sources of finance and external sources of finance. External sources of finance can be equity and debt, which we will discuss in detail in today's session. First, the internal sources of finance. When the entrepreneur manages the funds from within the enterprise, it is known as using the internal sources. This refers to the owner's own money, known as equity capital. It also includes the deposits and loans given by the promoters or directors, as the case may be. Sometimes the promoters raise the personal loan on their investments in life insurance policy, provident funds, fixed assets, or any other form of investments. If the business is already running, the entrepreneurs retain a part of earnings and plow back in the business for expansion. These retained earnings may not be very huge amount for small enterprises. However, it forms a part of internal sources. External sources include all other sources which are not internal. External sources of funds may be further divided into two parts: debt financing and equity financing. Debt financing includes the borrowings from banks and financial institutions for meeting the short-term or working capital and long-term or term loan capital requirements. It also includes issues of debentures, while angel investment, venture capital investment, private placement, private equity form the part of equity financing. The entrepreneur may face a dilemma here, whether to source his finances from internal sources or external sources. He or she may be confused whether to use equity financing or debt financing in the external sources of financing options that he has. It is essential to understand at this point of time that neither 100% debt nor 100% equity financing is desirable. So if the entrepreneur funds the entire business with the use of debt capital, then there is always an obligation to repay the debt along with the interest. So here, equity financing has an advantage, as equity capital is never repaid. Alternatively, If the entrepreneur funds the entire business with equity capital, it will result in total dilution of ownership and control. Further, the shareholders will not get the advantage of trading on equity. Trading on equity means use of debt products, which leads to higher earnings per share for the shareholders of companies. Hence, a business enterprise needs to maintain a proper balance between the use of equity and debt in its capital structure. This is well known as optimal capital structure, which has the following characteristics. Optimal capital structure is maximum return, minimum cost. Such capital structure should be flexible to accommodate the future requirement of capital for expansion. Use of debt should always be within the repaying capacity of the firm. The capital structure should ensure proper control to the promoter and should not result in complete dilution of control. In fact, following factors should be considered by the entrepreneurs while deciding the mix of equity and debt financing. So you have a mix of equity and debt financing whilst financing your new enterprise. These are the factors that you need to keep in mind while determining the capital structure. First is the nature of business and cash flows. Second is the size of enterprise. Third is trading on equity. Fourth is purpose of financing. And fifth is provision for the future. So the first factor that you need to keep in mind while determining the capital structure is the nature of business and cash flows. If the business is operating in a sector where the sales are subject to fluctuations or where the cash flows are unpredictable, such businesses should rely less on debt capital. On the other hand, if the demand for product is inelastic, cash flows are certain and can be predicted, such businesses can apply more of debt and less of equity capital. Second factor to determine the capital structure is the size of the enterprise. Investors, while investing in a new enterprise, consider safe to lend to large enterprises as compared to smaller ones. So the small enterprises will have to rely more on owner's capital or equity and less on borrowed funds. The third factor is trading on equity to determine the capital structure. If the rate of return on capital employed is higher as compared to interest on borrowed capital, the shareholders get the advantage of trading in equity. In such situation, there is greater application of debt capital. The next factor is purpose of financing. You should be clear about the purpose of financing a new enterprise. As an entrepreneur, for the productive purpose of financing, higher reliance on debt capital is justified. For example, if a term loan of 5 years is taken to buy a machinery with the useful life of 5 years, the interest on term loan can be paid out of the cash flows generated with the use of such machinery. However, if the purpose of machinery is not productive, use of owner's capital is justified. Finally, the final factor for financing a new enterprise and determining the capital structure is provision for the future. As businesses expand its operations, it will need more finance or funds. Hence, it is advisable to use the best securities at the last. All the financing options should not be applied simultaneously so that there is always a scope of modifying the capital structure in future. Sources of finance. According to pecking order theory of finance, preferences are given to the source of finance in some order. The entrepreneurs should first prefer internal funding option over external funding option. This is very, very important to make note of. In external funding also, the preference should be given to debt financing over equity financing. This is because as we move from internal funding to debt funding to equity funding, the risk of financing increases, and so as the cost of financing. The funding needs do not remain constant over a life of the business. At different stages of business development, the requirement of funding changes. Hence, the entrepreneurs should be aware about the source of funding as per the stage of business development. The first stage of any business is pre-seed funding stage. This is the first stage. Here, the entrepreneurs just have an idea. Here, the funding is needed to test the feasibility of the idea and conducting the market research. Here, there are no customers or market. During the seed stage, the business can rely upon use of bootstrapping techniques, which we will discuss later. This concept is explained in detail in the next section, as I told you. Once the idea seems feasible through market research, businesses move to the next stage, that is startup stage. Here, the prototype of the product or the service is ready. According to the findings of the market research and pilot testing, changes are made in the product or the service concept. Seed and startup stage, both are preliminary stage of venture development. Hence, the businesses in these stages rely upon their own money, personal savings, or borrow from their family or friends. One can also think of availing government grants at this stage. These days, the entrepreneurs can approach angel investors or crowdfunding platforms to fund the business needs at this stage. In the next phase, now the customer base is ready. The entrepreneur wants to expand his business with a new product or service, expand customer base and management team. So this is an early expansion stage in the establishment of a new enterprise. Here, the venture capital investors help the entrepreneurs in raising the funds and expanding the business through a series of funding. Once the startup is matured and at the advanced stage, it can also think of raising the debt capital from the banks and financial institutions as discussed earlier. In the last stage, when the startup wants to grow further and diversify, the option of offering the shares to public, that is IPO, private equity, private placement, etc., can be considered. This is the last stage of the startup funding stages. As we have come to know that finances have been one of the most important aspects of starting or operating most enterprises, many entrepreneurs have used a variety of bootstrapping financing methods to satisfy ventures' financial and resource needs without long-term commitments or external obligations. I'll now show you a table which profiles a thorough listing of bootstrap finance techniques used by entrepreneurs, which include social and economic transactions. Please take a look at the table of various bootstrap finance categories and the techniques. The first category of bootstrap financing is owner's resources. Techniques used in order to fund a new enterprise. Entrepreneurs use their savings account, sales funds, they raise funds through sales of securities or property, or foregone salary from other job, and residence for business use. The second category for bootstrap financing is owner's borrowing from installment or signature loans, lines of credit, credit cards, micro lending programs, franchisee lending, collateral loans, mortgages, home equity loans, insurance cash value, retirement account funds, online credit search, matching services. The next category of bootstrap financing is relationship resources. From cash contributions, property or equipment purchases, donated labor, and below market salary. Bootstrap finance can be acquired through barter, such as the service of goods trade, organized exchanges. Another very important bootstrap financing is quasi-equity from partnerships, finances generated from partnerships, angels, individuals or groups, adventure capital, incubators interest, and credit enhancements. Debt financing can also be done from cooperation resources like equipment or facility sharing, joint ownership, coordinated purchases, customer sharing alliances, and franchises supported advertising and services. Debt financing can also be done through customer financing, prepaid licenses, advance payments, customer funded research and development, letters of credit, and investor owners. Debt bootstrap financing can also be done through cash or asset management, such as trade credit, delayed payment, deferred taxes, overdraft privileges, account transfers, skip loans, accelerated receipts, short-term investments, inventory minima, used equipment, and theft control. You can also generate funds through leases, closed and open-ended leases, sale leasebacks, and venture leasing. Bootstrap financing can also be done through outsourcing from professional services, temporary employees, manufacturing cooperatives, and flexible networks. Bootstrap financing can also be done through subsidies and incentives, and such as direct and indirect local, state or federal funds, university resources, and indirect corporate funds. Finally, foundation grants can be used, like direct grants, flow-through arrangements. So what is bootstrap financing or the bootstrap technique? Bootstrapping technique work on the principle of a penny saved is penny earned. These techniques that I showed you in the table are a collection of methods to minimize the need to seek outside financing by a startup. Every successful company would have applied bootstrapping at the initial stage of their venture development. At this stage, where the investors are not willing to risk their money, it is good option to bootstrap the ventures and bring them on self-sustaining mode. These techniques also bring a discipline on the pattern of cash outflow. Some of the examples of such techniques are illustrated below. Buying used equipment instead of investing in new ones, renting the physical space instead of buying the land and building, working from home to save upon the infrastructure cost, availing discount from the suppliers, use of credit cards to pay for expenses and earning credit time for delaying the payments, partnering instead of employing to save upon salary, easy loan from family and friends to save upon the interest cost, sharing of equipment employees and office space for cost saving, employing the relatives and friends at below market salaries, obtain advance payment from customers. We have discussed each of these bootstrapping techniques in the earlier introduction to bootstrapping financing. There are many advantages. Some of the advantages is since the entrepreneurs do not raise equity or debt funding while bootstrapping their ventures, it gives a complete freedom and flexibility to them to implement their strategies. There is no interference of investors in the operations of the business. They can retain the complete ownership of the business as there is no involvement of external investors. One of the limitations of bootstrapping technique is too much of bootstrapping can prove to be very risky. There can be liquidity crunch. Sometimes it limits the ability of the startups to scale up and reaches its full potential without the support of investors. And there are many other limitations that you can take a look from this particular slide. While bootstrapping, the entrepreneurs might be multitasking, which at times may be stressful and time consuming. This is another big limitation. Now, coming to understanding who the angel investors are and who the venture capitalists are, first we take a look into angel investors. Business angels are consistently defined as high net worth individuals who invest their own money along with mentoring, networking, and expertise in startups with no family connection, in the expectation of financial gain, are widely recognized as the main contributors in financing early stage startups. In the funding process, business angels are a group somewhere between crowdfunding and venture capital concerning the amount of money invested, higher than crowdfunders and lower than venture capitalists. And to some extent, the stage of the startup development, they invest in earlier stages than venture capitalists, similar to crowdfunders, helping startups to overcome the difficult period of validation, sometimes referred to as the death valley. In contrast with venture capitalists, you will see, and crowdfunders, angels involve themselves directly with the entrepreneurs and invested startups to create value. Angel investors, as I have already told you, are known as seed investors, are high net worth individuals who invest directly into promising entrepreneurial businesses in return for equity shares in the companies at the initial stage of venture development. They can also be known as informal risk capital. The investment made by the angel investors are referred to as informal risk capital, as their investment approach is not very professional or formal, such as the venture capital investors. So these are the features of angel investment. Unlike traditional investors, angel investors invest in unconventional and highly risky investments. Angel investors bridge the gap between early founders, friends, and family financing, and later institutional financing. And we have discussed some of these features in this particular slide. They mostly invest locally. This is because they believe in hands-on approach. As noted earlier also, they are informal investors and their decision to invest in the startup is mostly driven by referrals. Reasons for angel investment, besides the financial motive, return on investment, there are multiple reasons for investment by angel investors. Some of them are, as many of the angel investors are entrepreneurs themselves, they know the common problems faced by many of the budding entrepreneurs. Hence, they want to come forward and help them. Angel investors are successful entrepreneurs and business leaders. Society has given enough name, fame, and wealth to them. They feel that now it is time to give back to the society by investing in the startups. There has been many research on angel investments. Angel investors operate markedly differently when compared to both bank and venture capital financing. Angel investors, therefore, fulfill an important investment gap in venture funding between personal finances and family friends financing and more traditional institutional ventures investors and mainstream financial service providers. You also find technology angels to invest in even earlier stages than their non-technology counterparts. Angel investments vary quite substantially, but the most recent average investment may be more than banks and substantially less than venture capitals. So there has been many research on angel investments, and it has been found that they have marked differences with venture capitalists. So we have discussed a bit about angel investment that has been going on for financing a new enterprise. Angel investment has been going on in India for a period of time. However, since last decade, angel investors are organized into groups and they mostly invest through networks. So this particular source, Indian Angel Network, these are networks in India like the Chennai Network, Rajasthan Network, Hyderabad Network, Chandigarh Network, and so on. This particular slide shows the number of angel investment deals in India. Angel investments and investors are important for several reasons. First, they make investments in seed and startup stage at dollar amounts for smaller than one would tend to find for venture investors. Such early stage investments are likely to have a large influence not only on the success of the firm, but also on its management, governance, and operations. So angels invest their money, their own money, where venture capitalists are money managers and invest capital provided by their limited partners. Venture capitalists are different from angel investors. These are individuals or institutions that invest their own or others' money at risk as risk capital or fund entrepreneurial firms. Entrepreneurial firms typically require capital from venture capitals to grow, turn around, or change the ownership of the business. Venture capitalists' equity is not easily tradable. Thus, venture capitalists expect their investment to be tied up until a liquidity event. Friends and families are considered as angels or petit angels. They invest in businesses due to strong personal relationship with the entrepreneur. We have seen that angels typically are involved early in the pre or post formation stage of entrepreneurial firm and often invest the money in the business after the entrepreneur's own money has been exhausted. Brokers are individuals who invest others' money in entrepreneurial firms. Most often, the broker organizes a private placement which entails completing an offering memorandum and then presenting the opportunity to investors. So typically, there are 500 corporations that set up venture capital subsidiary to invest in companies that have some strategic relevance to the corporation. Corporate VCs is especially common in high technology industries. The goal is to keep informed about the best new technologies with the idea that these companies may ultimately be acquired by the corporation. This type of venture capitalists mostly follow angels and brokers and occurs during the expansion or later stage of venture development. This particular slide shows the funding sources for entrepreneurial ventures. Either individuals use their own money or they use others' money. When they use others' money, they are called as brokers. When they use their own money, they are called angels. So institutions, when they use their own money, they are called as corporate venture capitalists, and when they use others' money, they are traditional venture capitalists. So we have discussed venture capital investors and entrepreneurs. The venture capital process can be shown using this few slides. Venture capital, the process that venture capitalists use can be thought of as a series of stages that each entrepreneurial firm must work through from the time the firm is first proposed up until the time when the venture capitalist successfully exists from the entrepreneurial firm and takes up its profit. We propose two broad categories. The first category, pre-investment activities, refers to all of the venture capitalist tasks to and including the signing of an investment contract. For example, soliciting the business plans from entrepreneurs, requiring funding, determining whether these proposals meet capitalist broad screening criteria, conducting due diligence, and then negotiating and structuring a relationship with the entrepreneur. The second category is post-investment activities. It includes all actions by the venture capitalists after initial investment deal has been signed with the entrepreneur. In general, this involves providing guidance to help improve the performance of the entrepreneurial firm. The emphasis in the venture capital process is on different activities, and that can vary among types of venture capitalists and among venture capitalists within a particular type. Ultimately, the venture capitalist's final action is to exit from the entrepreneurial firm. Venture capitalists has been one of the most widely researched areas in entrepreneurship. Major research areas within venture capitalists focus on pre-investment process, post-investment, and more recently, raising funds. So we can see that in the venture capital process over time, the research has become more theoretically driven and added depth to the earlier work by identifying biases and differences across culture and country. Moving into the future, there is a plenty of room for venture capital to be further investigated. The pre-investment process, including work around biases, context, quality of information, due diligence, and so forth. The post-investment process has also received considerable attention. Early research notes that while the investment decision is important, much of the venture capitalists' time is spent monitoring and advising entrepreneurs post-investment. So, we have discussed a little bit about the venture capital process, which you can see from the various slides. The process finally discusses that much of the work takes a human capital perspective and tries to identify which factors facilitate a venture capitalist's efforts in raising a first-time fund. This particular slide shows the structure of venture capital fund, which starts with limited partners who provide the funds to the general partners who invest and assist the portfolio companies. So there can be many features of venture capital investment, which you can see. Venture capitalists tend to invest in high-risk, unconventional ventures. They invest funds in the companies for long-term horizon. There is always a defined exit for venture capital investment, which is planned at the time of structuring the deal. Venture capitalists not only provide funds, but take an active part in the management of the firms. As venture capitalists actively involve and assist the investee companies, the valuation of such companies grows in the future. Hence, when they sell their equity stake, they realize very high returns in the form of capital gains. So this particular slide shows how the process of venture capital investment goes. It starts with the deal organization, screening is done, next is evaluation with the due diligence, then deal structuring is done, then post-investment activity, then exit plans. So then next source of financing is the term loan. We till now have discussed various sources of finance falling under the category of equity capital, which have been clearly been explained. Debt capital can also be availed by the enterprise through raising term loan or issue of debentures. Term loans from any bank or financial institutions are the long-term sources of debt availed by the enterprises. As the name suggests, this term can be short-term or long-term loans. The features are to be kept in mind are the purpose, currency, security, repayment, moratorium period, and restrictive covenants while thinking of taking a term loan. Debentures, like the term loan, are also debt instruments for raising medium to long-term capital. Those who invest in issue of debentures are known as debenture holders, and they are the creditors of the firm. Guidelines for issuing the debentures are mentioned in the Companies Act 2013. Some of the features of debentures are trustees, security, convertibility, interest, issue price, redemption, voting rights, debenture redemption reserves. Now, going back to the features of the term loan, you can see the purpose is the most important feature. The purpose of raising the term loan can be expansion, diversification, modernization, or renovation. For what purpose you are thinking of procuring a term loan is important. Likewise, in debentures, these features form a part which is important for financing a new enterprise. The trustees, security, the convertibility, the interest that you are going to get, and the issue price. Apart from this, redemption of the debentures, the voting rights, and debenture redemption reserve is important for financing a new enterprise. Thank you. We'll be discussing further in tomorrow's session. Thank you. But before we can wind up today's session, let us take a look at the various features and wind up today's session. Although we have discussed in full the various financing sources and the funding process and the structure, let us wind up by discussing in detail a bit about the features of the term loan and the debentures. As I have told you in our initial discussion, that while sourcing the funds for your new enterprise, you can look to take help from angel investors or venture capitalists, or you can go for term loans or debentures. Now, while going for a term loan, you need to, as I hinted at the first introductory discussion, that term loans, the first feature is important. The purpose of raising the term loan is important. Next is currency. Term loan can be available in Indian rupees as well as foreign currency. Foreign currency term loan can be availed for import of machinery, technical know-how, etc. The next feature is security. Term loans are always secured. The assets which are financed through term loan become the primary security against the loan. Other assets and guarantee can serve as the collateral security. Repayment is the next feature which should be kept in mind. Term loans are to be repaid along with the interest. Bank or financial institution will conduct the credit assessment before granting the term loan, and the interest rate will be charged according to the credit risk. As the loan is repaid every year, the interest burden will decrease and the financial repayment component remains constant. Term loans are usually repaid in quarterly or semi-annual installments. The moratorium period for term loans is also important. Some banks or financial institutions grant a moratorium period to the enterprise. This works like a grace period, and during this period, the borrowers are not required to pay any amount under equity monthly installments. This can be for a period of 1 to 2 years, depending upon the policy of the banks. Restrictive covenants is one very important feature of term loans. Some banks or financial institutions put restrictive covenants on the borrowers to protect themselves from any default or credit risk. These covenants are restrictive conditions on the borrowers. According to them, borrowing firms cannot take few decisions independently. These covenants can be related to assets, liabilities, cash flow, or management. They have to take the approval of the existing lenders for making any fresh investment, borrowing any additional loan, buying or selling of major assets, repaying the existing loan, dividend payment, organizational changes. Likewise, as I told you, while sourcing funds through debentures as an entrepreneur, to start up your new enterprise, you need to keep in mind the various features of debentures. You need to keep in mind the trustees. Normally, there are 3 parties to the debenture issue: the issuer, the trustees, and the debenture holders. To protect the interests of the debenture holders, trustees are appointed through trust deed. Trustees supervise the obligation of the borrowing firm. Next feature that you need to keep in mind while using debentures is security. Debentures can be secured or unsecured. Secured debentures are known as bonds. If the company issues secured debentures, a charge on fixed assets of the company is created, and the company issuing such debentures will have to follow the guidelines mentioned in the Companies Act. If the debentures are unsecured and the company defaults in payment of interest or principal, the debenture holders' condition will be similar to unsecured creditors. Now, convertibility is a feature of debentures. You should note that debentures can be convertible or non-convertible. Convertible debentures can be converted into specific number of equity shares in future as mentioned in the trust deed. Likewise, interest feature of a debenture is to be kept in mind while sourcing the funds. Debenture holders get interest regularly, either quarterly or annually on debentures. This interest is known as coupon rate. It can be fixed, floating according to the market rate, or zero coupon. Interesting is a zero coupon debenture. Zero coupon debentures do not carry any coupon and are traded at discount to the face value. Next feature of a debenture is issue price. Companies can issue debentures for cash. Further, they can be issued at par, value equal to the face value, at discount, value less than the face value, or at premium, value more than the face value. Now, whenever you are using a debenture, redemption is important. Debentures can be redeemable or irredeemable. Redeemable debentures are redeemed on the maturity not exceeding 10 years from the issue date. While in case of non-redeemable debentures, interest is paid to the debenture holders till the company wants to redeem or cancel the debentures. A very important feature of financing an enterprise through debentures is the voting right. Since debentures are a part of debt capital and not equity capital, debenture holders do not have any voting rights. The last feature of a debenture is the debenture redemption reserve or the DPR. On maturity, debentures are redeemed. To ensure the safety of the debenture holders, companies issuing debentures are required to create debenture redemption reserves out of the profits as per section 71(4) of the Companies Act 2013. This fund can be utilized only for redemption of debenture obligation. So before we wind up today's session, let me take you once again quickly through some of the research that is being done in angel investment and in venture capital investments. I have already told you that angel investment is done in the early stage. It is an early stage investment that may lead to the way for future rounds of investment by venture capital investors. You should know that angel investments are where angel investors invest their own money, but if you compare them with venture capitalists are money managers and invest capital provided by their limited partners. Since angels invest their own money as opposed to investing funds of other investors, they may be less likely to have the agency problems that venture capitalists are exposed to. So, if we make a distinction between angel investors and venture capitalists, you will see that angel investors may serve firms or industries that venture capital investors are not willing to serve, implying that there is some segmentation between the angel and venture capital markets. Since angel investors are likely to have a different set of skills and competencies compared to venture capital investors, they may provide valuable services to a different set of firms than those obtaining venture capital financing. Venture capitalists are those individuals or institutions that invest their own or others' money as risk capital to fund entrepreneurial firms. So we can see that they are having a distinction as compared to as compared to angel investors. So, if you take a look into the research that is going into venture capital investments, you will see that traditional venture capitalists are institutions that invest others' money in entrepreneurial firms. The most common form, as seen in US, is a limited partnership. The venture capitalist becomes a general partner contributing minimal dollars to the fund, and the limited partners contribute the remainder of the money to the fund. In essence, we can say that limited partners are investing in the venture capitalist expertise at identifying and building winning entrepreneurial companies. In return, limited partners receive 70-80% of the capital gain on the venture capitalist investment. Venture capitalists receive the remaining 20-30% of the capital gain, that is the carried in interest, plus an operating expense fee of 2 to 3% of the capital under management. Venture capitalists can invest at all stages of a company's development depending upon the venture capitalist charter, but most commonly they come in during expansion and later stages. Angel investors come in the opening stage of the startup, but venture capitalists they commonly come in during the expansion and the later stages. Traditional venture capitalists invest in only about 1/10 of 1% of all businesses, although these businesses have the potential to be world-changing enterprises. Let me give you an example. Google, eBay, Facebook, and Twitter are just a sampling of venture capitalist-backed ventures that have transformed industries. So we have discussed the venture capital process. It starts with the pre-investment activities, which refers to all of the venture capitalist tasks to and including the signing of an investment contract. The second category we have discussed is the post-investment activities, which includes all actions by the venture capitalists after the initial investment deal has been signed with the entrepreneur. In general, this involves providing guidance to help improve the performance of the entrepreneurial firm. And one of the most important benefits arising from a relationship with a venture capitalist is access to their extensive network. This is often utilized to find and recruit top quality management, to find other investors for immediate or follow-up investment, to introduce the entrepreneur to important service provider such as specialized accountants, or to help find and develop necessary strategic alliances. Ultimately, the venture capitalist's final actions is to exit from the entrepreneurial firm. Venture capitalists has been one of the most widely researched areas in entrepreneurship. So, major research areas within venture capitalists focus on the three stages of the venture capital process, which we have discussed today. One is the pre-investment process, second is the post-investment process, and more recently, raising funds. So the pre-investment process has the longest history and is often anchored when you go through the entire VC process. And the last phase is about raising funds through venture capital, which we have discussed in today's session. So we have discussed in detail about the angel investors, about the venture capital investors, about term loans and the debentures. And you should note that you have to go through all the steps in the process of investment. Like in the venture capital process, you need to keep in mind that the early investment stage is important. It again is a process as compared to the post-investment process, and finally raising the funds. Now, over time, if you take a look at the venture capital process, research has become more theoretically driven and has added depth to what has been discussed today. It also identifies biases and differences across culture and country. Now, moving into the future, venture capital investment, there is a plenty of room for that, which needs further investigation. Investigation to the pre-investment process, including work around biases, context, quality of information, due diligence, and so forth, needs to be focused while investing through venture capitals. The post-investment process has also received considerable attention, but as I told you, raising funds has become important for venture capitalists. So the early research notes that while the investment decision is important, much of the venture capitalist time is spent monitoring and advising entrepreneurs about post-investment and raising funds. So we have discussed in totality the various sources of funds that you need to keep focus on while financing a new enterprise. And all of you should know that the relationship between the entrepreneurs and the venture capitalists is important. And it often hinges on the relationship between control and trust. Research on value-added activities also examines how venture capitalists add value by mentoring entrepreneurs and enterprises, providing access to venture capital networks. And the post-investment process continues to provide opportunities for further investigation, exploring such issues as conflict management between venture capital and entrepreneurs can keep you in good stead. And what is important above all is the reputation of venture capitalists and how it enhances its ability to add value and so on. So having discussed in detail about the financing of an enterprise, we wind up today's session. Thank you.